So with that, I'm going to hand it over to our speaker, Duncan Eng. He is a financial planner with Private Wealth Financial Planners, and has been doing this since founded this company in 2008, which is same number of years that I've been in real estate. So very interesting time to start a business during that Great Recession. But I'm very thankful to have him here. I am also going to be asking Elsie Wu, who is a great friend and colleague as well, and who's introduced me to Duncan, because my voice is kind of I'm a little bit hurt today. So Elsie will be helping to moderate a little bit. So I'm going to hand it over to them.
Thank you, Jean, and thank you, Elsie, for inviting me to talk to everybody here. So the agenda today is some acronyms here. DST, QOZ fund, a long-term care, guaranteed lifetime retirement income. Each of these items fit well within the idea of preparing for the golden years or in the golden years. Delaware's DST stands for Delaware Statutory Trust. What are the benefits? And what is a Delaware Statutory Trust? I'm not going to read every line on this page, and I don't want you to fall asleep here, but this is the technical definition of a Delaware Statutory Trust. Simply stated, it's a trust that is tasked with purchasing or investing in real estate. And the real estate or a DST can be bought and sold through a broker dealer, not through a real estate agent unless they're securities licensed, but through a broker dealer. A DST investor is called a beneficiary. They own a fractional interest in the Delaware Statutory Trust. And the IRS treats the fractional interest as direct real estate. Okay. It's eligible for 1031 exchanges. This is not a real estate REIT or REIT. REIT does not qualify for a 1031 exchange. Only a DST will, because the IRS gave it that designation as a direct property ownership. So the benefits of a DST. The benefits of DST is normally you get commercial grade real estate assets. What does that mean? We're talking about multifamily housing, self-storage. We're talking about, medical office, Amazon distribution centers, things that are worth, upwards of, 50 million, 100 million. Normally in a DST, in my experience, they may have 2 or 3 properties in a DST. Or if they only have one, you can own multiple DSTs in your 1031 exchange. So you may be able to own an Amazon warehouse and then also own a multifamily. And you can split that purchase, $300,000 for one, $300,000 for another one. And based on what Jean and Elsie just went through, to buy one piece of property here in the Bay Area, that could be $1 million, right? Or $2 million just to hold a piece of property. So you're allowed to use a $2 million property sale and break it up into smaller pieces in order to get different real estate sectors and be diversified. So it's a limited liability company, which is why is that important? Well, before everybody got on, Elsie and I, Jean and I were talking about the amount of regulations that have come to pass with being a investment property owner, right? Renting property out. There are many things that you can get fined on. There are many things that can put you in jail on. There are many things. Well, limited liability means that when you're in a DST, you cannot lose more than your investment in the DST. Whereas when you own your own piece of real estate and whether it's 5 units or whether or not it's 5 different homes you're renting, your liability is unlimited, right? Any tenant or person visiting the unit can potentially sue you. In this scenario, the benefit of a DST is you're limited in your liability. I briefly touched on diversification of property types. Like I said, there's many property types available, and geographically, uh, most of the most of the things that we're using are in Florida, Texas, North Carolina, Arizona. So it's geographically diversified. Even in New Jersey, some of the items are there. Washington D.C., things like that. So you get away from just being California based by using a DST. And for all those that have done a 1031 exchange, you understand that there's timing involved. You have 45 days to identify. You have 180 days to close. Many people right now, based on Gene's chart, have a very difficult time identifying a property when the inventory is so low, right? It may be a great time for you to sell because inventory is low, medium prices are up. However, how do you do the exchange or the down leg in the 1031 exchange becomes a very hairy and um, frightening thing that you may not be able to identify something and close on it in the time frame. Once you fail your exchange, you pay all the capital gains on the property. So if your property back when was $1 million in 2017, and now it's worth $2 million and you sell it, well, there's $1 million capital gains in there that you're trying to defer, and the DST allows you to identify and close and get a rent check in 2 weeks, right? Sometimes if you do an exchange, your next rent check may not be for a month or two. But in a DST, you can be receiving your rent check 2 weeks after the money hits the escrow account and the money moves. In 2 weeks, you can be getting a rent check again very quickly. Professional management. Jean mentioned earlier that, hey, some people don't want to deal with the tenants, the toilets, the trash, the trouble anymore. They'd rather be in Hawaii, which is where this picture is that I'm sitting in front of. They'd rather be in Hawaii, hanging out for 2 or 3 weeks and receiving a check in their bank account. And they go to the ATM machine and they pull out the money they need in Hawaii or in Europe or in China or anywhere else you want to be in the world. You just go to the ATM machine and pull out the money and spend it. I've had plenty of experience with clients who are amazed that the check shows up and they get to use it without having to work for the rent check anymore, right? That's one of the main benefits of DST. The other benefits is estate and income tax benefit. Some of you may have owned property for 20, 25, 30 years, and you don't have any more depreciation on your property. Therefore, every single rent check you're receiving, you're paying taxes on. In a DST, you can get a loan without having to qualify for the loan and buy more property. So you sell a $2 million property, you had no debt left on it, you had no depreciation left on it, but you're not really interested in trying to file for a loan because you're not sure if you would get one. In this scenario, in a DST, if you qualify to participate in a DST and invest in a DST, and the DST already has 50% loan to equity, you immediately bought $4 million worth of property. That means you gained a $2 million depreciation schedule, where before you had no more depreciation because you have outlived or you have fully depreciated your asset. And for state benefits, it's very difficult to take property and then say my 3 kids or my 2 kids or my 5 kids are going to own these 3 properties that I have. And if I was looking at you in live, you may have seen some difficulties with maybe a handful of children trying to figure out what they're going to do with real estate when you've passed it on to them. And with a DST, the beautiful thing about this is your 5 kids, if something happens to you, they'll all get 5 shares, each of them in their own name, equally down to the penny. And all you know that it's very difficult with real estate to say we can divide it up down to the penny when you've got 2 or 3 different types of property that are being inherited. That's one thing. And the estate also, on the estate side, is that for those of you lucky enough to have an estate tax problem, meaning your net worth is in excess of $14 million, the DST will give you an estate tax break and lower your estate tax payment that would be due for your heirs. So again, very beneficial, plenty of experience with this. QOZ and a QOZ fund, qualified opportunity zone versus a qualified opportunity zone fund. And what is the benefit of the qualified opportunity zone fund? We'll discuss that. Again, the next page will be very difficult to maybe read, but this is very technical, so don't fall asleep on me. The qualified opportunity zone is economically distressed community. So what does that mean is that, simply put, each state was given the opportunity to identify places that they considered economically distressed communities, communities that needed investments to improve their situation. So downtown San Jose has areas that are considered qualified opportunity zones. The area around USC, University of Southern California, has, if you've ever visited 10, 15 years ago, you would be scared to walk around the campus because the campus is behind a fence. Well, that particular area is a QOZ, and they now have provided student housing in the area, and it's 95% full with USC students. Now, it doesn't need to be USC students. It technically can be anybody, but with the proximity to the college or the university, it's mostly students or all students. And since students don't earn any money right now, the area immediately, based on statistics, is considered poor because the students themselves don't earn an income. Therefore, the qualified operating zone, which is an area, qualifies for this designation by the government. So what is a qualified operating zone fund? Well, the fund is an investment vehicle that invests and builds in the qualified operating zone. That's why they're slightly different, but they're one and the same. One is called the investment vehicle, and the other one is the actual locations that you may invest in order to get the benefits the IRS is providing. So what is the IRS providing for you to take your money and make a risk in a economically distressed community? Well, what they're saying is all the capital gains that you may have from the sale of stock, from the sale of your home, from the sale of collectibles, artwork, any capital gains may be deferred till 12/31/2026. Now, Jean mentioned that she had talked about QOZ's early days back in 2015. Well, 2015 and 2016, that means your deferral was almost, 2016 to 2026. That's almost a 10-year deferral range, right? But it started out 7 years, and every year it gets shorter. So from now, it's going to be 2026. So 2024, no capital gains due. 2025, no capital gains due. 2026, capital gains will be due, payable in 2027. So what the IRS is allowing us to do is use the tax money owed to the IRS in order to help you mitigate any risks that you may have taken by allowing you to make money on the taxes that you would have paid. Right. So the Opportunity Zone Fund, again, 12/31/2026. If the investor and all the sponsors that work in this space plan to hold the investment for 10 years, because after you hold the investment for 10 years, the entire gain on your investment is tax-free. Let me repeat that. And let me give you a simple example. You made a $200,000 gain from the sale of your stock or the sale of art or collectibles or your home. The principal does not need to be invested in the QOZ fund, only the gain. So you sold the home for $2 million. The gain was 200,000. The 200,000 gets invested in the QOZ fund. The taxes on that $200,000 is now deferred till 12/31/2026. Now the $200,000 is not liquid anymore. You got to hold it for 10 years. After the 10 year, the investment in the real estate, let's say in USC, student housing, went from 200,000 to 500,000. So you had a $300,000 gain on that investment. The $300,000 comes back to you income tax free. Let me repeat that. That $300,000 comes back to you income tax free. And what's the other benefit the government's looking for? They now have developed a distressed area in the country. You've created jobs, you've created housing, you've created businesses with your investment, and the government is encouraging that by allowing you to defer your taxes and by allowing you to have an investment returned to you income tax free. So you can see a list of self-storage, multifamily, student housing, hotels, medical office. There's no restriction as to the property type that can be used in the QOZ. Even for those of that you have already filed your 2023 tax return, and you said, boy, wouldn't it be nice if I knew this when I had to pay my capital gains taxes on this capital gains? Well, believe it or not, you have 180 days to invest the eligible gain in a qualified opportunity zone fund. 180 days. That means if your gain was in November or October of 2023, you still could participate in a QOZ fund because you have 180 days to make that investment. Now, for those that say, hey, I filed my return, I paid my taxes, I'm not going to worry about it. Technically, you could amend your return, ask for a refund from the government, make the investment in the QOZ fund, defer the taxes that you already paid for another couple of years, and then reap the benefit of a tax-free gain by investing in a QOZ fund.
So if someone gets into this QOZ fund now, let's say this year, they have to hold the investment for 10 years, for at least 10 years.
Yes.
Does that mean that the underlying property in the fund has to have been sold by them before they can exit, or they cannot be sold before they can exit?
There is no liquidity and there is no exit before the sponsor sells out the properties. So that's the way it works. Now, if you wanted to, quote unquote, get out of it, you would lose any gain that may be recognized, you would be taxed on. And you would lose, obviously, your deferral if you were leaving before the taxes were paid on the deferral. So if you left after 2026 and you were, let's say you were trying to leave in 2027, well, you already paid the deferred capital gains taxes because they were due. Now you would lose any potential gain that may be in the Opportunity Zone Fund. But at this point in time, you may only, because the Opportunity Zone funds, a self-storage, multifamily student, they're also paying rents. So you will also receive a tax-sheltered rental income stream to help you if you're retired in your retirement. or you're trying to build income streams into retirement without working, right? Without having to work. So there is, there would be no way out. So that is a huge negative of DST, and there's a huge negative for the qualified operating zone fund. In the DST, very difficult to get out as well, because you're going to be holding that from anywhere from 7 to 10 years until the sponsor decides to actually sell the property.
On the slide, it says defer of capital gain tax until December 31st, 2026. So that benefit of the qualified opportunity zone expires?
Okay, so that's a really great question. Boy, really intuitive. The first thing is the industry as a whole is hoping that the qualified opportunity zone fund or the qualified opportunity zone gets extended, because it is supposed to sunset in 2025, right when all the income tax rates potentially go back up. So there's a huge lobbying effort, and both administrations, and I don't want to get into politics here, but these are facts, right? Whether you're the current administration, or if the current administration loses and you're the new administration, both administrations like this technique, like the strategy, because one, it helps the wealthy out in a big way, and for the other party, it helps out the economically depressed areas in a big way. So each party likes it for different reasons. One, because it's helping out economically depressed areas, and the other, it allows wealthy individuals to defer their tax as well as gain tax-free on their investments. There's not a lot of things that offer tax-free on your investment. You buy real estate, it goes to $2 million. That $1 million is taxable, right? In this scenario, you buy $1 million, it goes to $2 million. That $1 million is not taxable. Very few things in the tax code and in strategy wise that will give you tax-free. And this is what this does.
So Duncan, we have a couple of other questions about DSTs and the qualified opportunity zone. So Don has a question about DST,
Sure.
and that question is: if I buy an office building and then for a DST, if I buy an office building, then do I create a DST and my property is under the DST?
The DST is really meant for investors to own a fractionalized interest in, because if you buy a property, an office building already, there is no purpose that the Delaware Statutory Trust will provide you except for the potential limited liability concept. But for that, you can simply use a limited liability company, or an LLC format would be simpler to implement if all you're looking for is limited liability or asset protection from suits. The benefit of the DST really is in the exchange process. So if you were here and you were telling me, no, I want to open up a DST and I want to be able for people to buy fractionalized interest in this office building that I have, well, yes, you could do that. Correct. But I'm not quite sure if that was the question. That's where they were going to.
Right. So the second question is from DJ. Duncan, your example of the $2 million depreciation, the sudden increase of $2 million depreciation is very interesting. So the question is, how is depreciation handled? Is it based on the property that was sold, or the percentage of the DST ownership?
Okay. So that's a great question. People are thinking, which is really awesome. So what's going on here is that your initial property that you sold was $2 million. DSTs offer zero loans, or they offer 30%, 40%, 50% loans to value. So the example I used was basically 50%. You put in $2 million, what you actually bought was $4 million of real estate. The $2 million that you all fully depreciated that one's all done. The 2 million additional that you purchased, you gain a new depreciation schedule on. And that 2 million is based on, the 30-year, 25-year depreciation schedule that you would use on it. So your tax professional, and I really appreciate Gene doing the disclosures, because that's absolutely true. Talk to somebody like myself, your lawyer, legal person, because all of these things work, but they don't work for everybody. Some people have a need, some people don't have a need. So that's why, and calculation of capital gains, best used by a tax professional, 1031 exchanges and DSTs and the rules, you need a intermediary to help out. So there's a lot of moving parts. So it's best, left to professionals to help out. But hopefully that's how you get additional depreciation, and that's how it's then depreciated. Okay, so this is where participation would be helpful. Like, if I was looking at you all in a room and I asked how many people know of somebody, family, friends, co-workers, etc., gym buddy, tennis, a colleague running with you, who knows somebody that needs help with bathing or dressing or ambulating, continence eating, or has Alzheimer's? That's what long-term care coverage is about. So how does it work? This care may be at home, assisted living facility, nursing home, adult daycare. And when does it happen? Sometimes happens when there's an illness, sometimes a broken hip, a stroke. Any one of these things may cause you or your loved ones to lose the ability, any 2 out of the 6 activities of daily living. And once you lose any 2 of the 6, you may make a claim on the insurance. So why is long-term care important? One of the reasons is that you don't really want to burden your children or other family members with your care, right? Some of you may be taking care of people right now, right? And I know you can do it out of love, but no matter what, it becomes a burden as your children may be still working. They may still have children in the house. They may still be in a career. So it adds stress to the family when you are added to the mix of having to be taken care of. Long-term care is important because unfortunately there's a statistics out there that says the spouse who's giving care may die well before the person that needs the caregiving. Because again, it's a very stressful environment to be taking care of a loved one. It's different when it's a third party. There's less emotions in that caregiving. Whereas when it's your spouse, it becomes much more stressful. The other thing about this is running out of money, right? People will say, I'm going to do everything for my husband, or I'm going to do everything for my wife, and they're not going to worry about it. And as the bills start piling up, then they realize that, oh my gosh, I just used what I thought was going to be my retirement money for long-term care. Here's the other thing that we experienced ourselves in my own family. My father-in-law needed more care than my wife and I could give. And it was obvious that we couldn't give everything that he's 95 years old now, couldn't do everything that he needed. So we ended up adding care and adding help in order to improve his care. That made us feel better. That made him feel better. He wasn't now embarrassed when we were in, the bathroom, the restroom with him. He felt more comfortable with somebody else. So again, provides better care. It also preserves the wealth for your heirs, because the money that you're spending on this care is reducing what your heirs may receive. Some of you will say, I plan to die broke anyway, so that's a good thing. And others may be saying, oh, that's not a good thing. I really do want to preserve the hard-earned money I've created all my life. So this allows you to move that payment from your own pocketbook to an insurance company, preserving the wealth for your children or grandchildren or whoever. Retirement income is guaranteed for a lifetime. So for those that know a fireman or a school teacher or a county worker or a state worker, they know what this guaranteed lifetime income is. It's called a pension. That person cannot outlive that payment. That payment will continue on for the entire life. And there's another statistic that was a survey that was done. The happiest people have guaranteed lifetime income. They're less stressed and they feel better. So what's a fixed income or fixed annuity? The fixed annuity is a lifetime payment that's fixed. The payment never goes up, never goes down, and it never goes away. There's no control over this type of investment. You are told basically what your lifetime payment will be. So if you took a $500,000 investment, multiply that by a 5% distribution rate, that means you'll pay $30,000 for the rest of your life. No matter what that $500,000 becomes, that $500,000 can be zero and you're still going to get your $30,000. So there's not, the $500,000 basically is gone. Your heirs won't receive it unless you decide to have a payment over two lives, husband, wife. So that $30,000 goes over a husband's life, goes over the spouse's life. And when both of them are passed, there is no benefits anymore. So that's called a fixed annuity. The variable annuity side, it's invested in stocks and bonds, in the market, real estate. There's a benefit income base and an actual investment balance. The benefit income amount actually grows every year. Some contracts will say 5%, some contracts will say 6%. So it varies. But even if the market is down 20% or 25%, that benefit income amount continues to grow at that specified amount, 5%, 6%. If your return is greater than 5 or 6, you get to lock in that return in that benefit income base every year, annually. So the actual investment balance can easily become less than your benefit income amount. But your guaranteed income is based on your benefit income amount, not your actual investment balance. So your benefit income amount can be higher and generally will be higher because of the 5% automatic growth or 6% automatic growth, or the actual return balance that you receive. So if your actual investment balance exceeds your income amount on an annual basis and on the anniversary, it'll get locked in to that new actual investment balance. The annual guaranteed growth during the accumulation period we just went over, then the guaranteed income for life could be a fixed payment or a variable payment. And the payments are insured by the life insurance companies. So there are contracts that will say, if you're willing to accept a variable payment, if the market does well, then you get a bonus payment at the end, at the new year. So if your guaranteed payment is $30,000 a year and you choose a variable payment scheme, you can never get less than, let's say, $30,000, but you can get a bonus payment of $5,000 because the market did well. So your next year payment will be $35,000. And if the market continues to do well for you, let's say it goes to $40,000. Well, your payment will be $40,000 and your guaranteed income base or your guaranteed income may move to $35,000 because it moved up because the market did so well. So both items works for various different people based on their ability to understand the stock market, or they feel better with a fixed payment that doesn't go up or down for life. Benefit of guaranteed lifetime income, normally we use this to fund your essential expenses, such as healthcare insurance, mortgage, food, and clothing. Shelter and food is really the thing, right? So let's say that number is $100,000. And everything above that is play money, whether or not you go to Europe or you go to Asia, you go to Hawaii, or you go somewhere. That can be variable. So we generally don't try to fund that variable expense through an annuity or a lifetime income format. Maybe that's more left to investment portfolio with full liquidity, right? Use guaranteed income to protect your basic essential living expenses. And you have a worry-free retirement because you're always going to have shelter, you're always going to have food, and you're always going to have insurance. Here's my contact information for any of you that have questions about anything that was covered or anything that you have questions on. Like she said, I am a financial planner. My firm is Private Wealth Financial Partners. My LinkedIn to learn more about myself is available there. And you'll see if you can leave the slide up and we'll take questions as well.
So, Duncan, I've never looked into an annuity. Who's the best person to use annuity? And do people actually, I mean, I know you said it's guaranteed lifetime.
Mm-hmm.
So if people spend, if people, something happened and they don't live that long, does that mean that the money is just gone, or does that get returned to their estate?
Yeah, there's two ways to handle it. So just like I was talking about a fireman, a policeman, a school teacher, etc. If you're familiar with a pension, normally when that person passes, the payments end. Or if you choose in a pension to have a payment of 50-50, in other words, at the passing of the person that earned a pension, 50% of the income payments will go to a spouse. So in that scenario, the payment is over 2 lives, right? So your question may be more like, okay, if it's over 2 lives and the second person passes, is there any more benefits? Well, that depends on the design of the annuity. Some annuities, you can say, if I pass away within the first 10 years of turning on this guaranteed income, the rest of the payments will go to a person I named as beneficiary. So it gets paid over me, my spouse, and it was only year 5. And somehow both of us passed. Car crash, airplane, whatever. Then the last 5 years will then go get paid to the children. So if it was originally a $500,000 investment, you got paid out in the first 5 years. The last 5 years will likely pay a lot of that remaining $500,000. That's one concept. The second concept is on the variable annuity side. Remember I said there was an account value balance? That will go to your heirs or after both of you pass if there was any balance left. For instance, real life example, client says, my child is really bad with money, Duncan. He or she is really terrible. So instead of me leaving them $1 million and letting them do what they want to do with the $1 million, I am asking in my estate document for the trustee to purchase a lifetime annuity for my son. My son is now 50, or my son is 60 when I finally pass. Well, that $1 million will then go, let's say, purchase an annuity that is going to pay 5%, 6%, going to pay their son, $60,000 a year for the rest of his life. So he will never run out of money, and technically may never be under a bridge, even though he doesn't know how to handle money. So there are many uses for an annuity, and that's a simple use that people do it for people that don't handle money well.
So one of the questions that we got from Troy is, I'm already very close to my retirement age. Is it still advisable to consider annuity?
Oh, absolutely. Because the way annuity works is that there's what's called immediate annuitization. So let's say you need $50,000 guaranteed. Well, based on your age and based on the amount you're to invest, if you were to hold a traditional stock and bond portfolio, they may say, yeah, you can pull out 5% out of that stock and bond portfolio or out of that real estate investment. But if you fully annuitize a contract when you're closer to retirement, your payout may be 7% or 8%. I recently did a contract for a dear friend and client, and he says, Duncan, so how much money do I need to put in this one to get a $70,000 a year payout? Well, based on the fact that this is paying out, 7.5% distribution rate, all you have to do is put in, let's say $1 million, and you'll get $70,000 every year for the rest of your life. If I had to do that in a portfolio, I would say we would pull out $50,000 a year and be comfortable that the $1 million will still be there, for the rest of your life. All right. So there's a reason to use an annuity close to your retirement in order to preserve a portfolio or real estate, because you can use less of it to guarantee a bigger number.
We have some more questions about DSTs and opportunity zones.
Perfect.
One person asks, Don asks, where can I, or how can I go about participating in that opportunity zone fund? And then Dan also earlier asked, can anyone get into an opportunity zone fund, or does it have to be triggered by a capital gains event?
There would be a lot of people that would want to participate in QOZ fund, but it has to be a gain. As a matter of fact, if you go back to the paperwork, it says qualified gain. So that really means you sold a house, you sold the stock, you sold bonds, you sold art, you sold collectibles, you sold a farm, you sold something, and that's the gain. You're not allowed to put principal into a qualified opportunity zone fund, meaning the basis of the sale. So simple example again, you sold $1 million house, you had a $300,000 gain. That $700,000 gain is not allowed to be invested in a QOZ. Only the $300,000 is allowed to be invested in a QOZ. The second thing is, not everybody qualifies for these solutions. A lot of times you have to have $1 million of investable assets, liquid, and or you have to be a married couple earning $300,000 to participate in a DST or a qualified opportunity zone fund. So it may not fit everybody. And just like long-term care, you got to still medically qualify for long-term care. A lot of people will say, well, you know what, it's long-term care can be expensive. And I said, not as expensive as you don't qualify and you need it. Then it's really expensive because now you can't get it, right? So first you got to qualify medically, and then you can talk about whether or not, the dollars and cents makes sense for you. But if you can't qualify medically, you can't get long-term care anyways. So yes, all these things have a solution, but you have to qualify.
And how much does long-term care insurance cost for someone who qualifies?
Okay, so that really all depends on your age and your sex. Females are more expensive because they generally will live longer and collect on the long-term care, and they need it. They'll be the ones that need it. For us guys, we just hope we die instantaneously, and therefore no long-term care is required. But no. So if you're a male, it costs a little less. Females, it costs a little more, and it depends on age. So we used to recommend people getting it in their 50s. Now we're recommending my own kids to get them sooner, as soon as they can, because the cost is so much less when you're younger than as you get older. So the planning is get it earlier, the better. Not like years ago, we used to then recommend, hey, you can wait till 50 or you can wait till 55. That whole idea is now gone. It's when you want it, you can qualify for it, you should get it.
Okay, so the next question from Troy, it's going back to the DSTs and Qualified Opportunity Zone Fund. Are they private investments, and how do I go about finding them or searching for them? And then the second part of that question, if I lose such money with such investments, can the loss be offset from other investment gains?
Okay, so the first thing is to find DSTs and QOZ funds. Since you have to qualify to participate, you can't just look at it. You can't just Google it. There's no way, because I didn't present to you today an example of a QOZ or a DST, because on this call, on this webinar, I haven't asked you, all of you, whether or not you qualify, because a person like me that securities license cannot speak to anybody that does not qualify about a particular offering. That is how strict the FINRA and the SEC rules that manage this solution or product has made it. So if you're interested, you can look me up, give me a call. I can show you what is available as long as I can determine that you qualify.
And then
So-
the second part of that question is if I suffer a loss from such an investment, can I offset that with gains from other investments?
Yes, a DST, as the IRS has stated, is real estate. So if you lost in a real estate investment, you get to offset long-term capital gains in other areas. And the QOZ, it would be that I'm going to have to ask you to, take your name down and me double check, because the issue there is that they're giving you a tax-free gain, right? So if you had no gain or you suffered a loss, would they allow you to take that loss? And I, believe it or not, I've never had to address that. So I would have to look that up for you, because I don't want to give you the wrong information on that front. Because in the time that I've worked with qualified operating zone funds, nobody has suffered in my experience with the sponsors that I have utilized, nobody suffered a loss. So I can't tell you that what would happen, but I can look that up. So if you don't mind, my email is on here, duncan.eng@lfg.com. And if you want, send me it, tell me that you attended this, and I'll look that up and get an answer to you.
Hey, great. So Duncan, the next question is from me again. And I just want to make sure that I'm understanding these DST and qualified opportunity zones correctly.
Sure.
So let's say I bought a house 30 years ago. It was worth $200,000 when I bought it. Now it's a $2 million house.
Mm-hmm.
So I have a capital gain, assuming that it didn't do any renovation. $200,000 is my cost basis.
Right, cost basis.
I have capital gains of $1.8 million.
Mm-hmm.
If I were to sell it the normal way, and this is my primary residence, then I would be paying 35%
of the
tax,
1.8 million.
the
Right.
1.8. So if I were to, if this was my primary home, if I were to go travel around the world, going to Oregon with Robert and Kathleen, and let's say I rent my home out for 2 years,
right,
then I can potentially do sell the property, take the $500,000 tax-free gain, the tax exclusions as primary residence,
correct,
and do a 1031 exchange,
correct,
on the 1.5 million.
correct.
1 point.
Yeah,
No,
you sold it for 2
$500,000.
million. Yeah, you sold it for 2 million. You took out 500. The 1.5 million, you do the DST on.
Okay, so that my original purchase price of 200,000 does not come into that picture at all.
No.
Okay, so then in the qualified opportunity zone, if I were to sell it that way, then I can take my gain is $1.8 million.
Correct.
I don't have to pay taxes on the original $200,000
No.
purchase price, and then I take my $500,000 tax exclusion, so I can get $700,000 out.
Correct.
And then invest the 1.3 in a qualified opportunity zone.
Correct. You did the math correctly.
Okay.
Yes, and then you get to defer the 35% for the couple years, and that will come due. And what the sponsors generally do with, let's say you put in $1.3 million, like we said in this example, they would return your capital in that couple years enough for you to pay any taxes that are due. Because what the sponsors will do is they'll go and grab a loan, a construction loan on the property, or a mortgage on the property, depending on the stage of the project is in. If the property is all built, they'll get a mortgage. If the property is still being built, they'll get a construction loan, and they will then return to you principal in order for you to pay the taxes due.
So Duncan, I'm going to throw a question at you. If you were to retire next year and you're moving out of the area, going to Hawaii, what would you do with your primary residence, or what would you do with all these 4 investment options? How would you allocate?
Oh, okay, that's a good question. If you're moving out of state and you're not, you don't have any kids that you're going to come back to or anything like that here in California, whatever, and you want to call it quits, and you were going to sell your home that has tremendous amount of gain in it because you've been here 30 years, 40 years, what have you. In my scenario, because I have family elsewhere, and I also own real estate elsewhere as well, it would be so simple for me to do the 2-year strategy that you had mentioned. But
With
if I didn't have real
two-year
estate,
rental, the 2-year
yeah,
rental you're talking. Okay.
turn it into a rental, do the DST, take a income stream, go to the ATM while I'm in Hawaii or whatever, go to the ATM and pull out money and spend it, right? Because the DST is sending money out. By the way, I've used this technique to retire people to Oregon, retire people to Vegas, retire people all over the place, right? This particular strategy, using a DST format, money going to them, go to the ATM, take it out. So retired plenty of people in this concept because their house was one of their biggest assets that they got while they were in California. So that would be one strategy that I would definitely use on my own scenario. However, I do have other clients that say, well, Duncan, I like to buy a place in Hawaii. Oh, okay. And I live here in San Jose, but I have so much gain in my property and I don't want to pay I don't want to, I want to defer the gain and, pay less. I'm okay with paying it in a couple of years, but not right now. By deferring it, I get to use the tax money to help me grow my wealth. So what this particular client did said, okay, I bought that place for $1.2 million, and now it's 3 million. So I'm going to take the $1.2 million plus some of the um, renovations plus my $500,000 I get. So I'm going to take that $1.7 million, $1.8 million, and make a down payment in Hawaii, and then the rest I'm going to use in the DST. So 3 million minus the 1.8, so maybe 1.2. I'm going to use that to invest in the DST because I need the principal or the cost basis to do something else with. So I'd rather use the DST rather than I'd rather go to the QOZ route rather than the DST route, because then the DST route, I got to put all my money in the DST, right? If I sell for 2 million, I invest for 2 million, except for the 500,000 I get for my personal residence and my cost basis, right? I still have to put in everything except for basically my exclusion amount if I don't want to pay taxes on it. So a lot of people, depends on what they need the design for, whether or not it's a DST or a QOZ.
Okay, so Duncan, one final question for you, and that's from Troy. The rental stream from DST, are they stable and guaranteed?
They are stable. They are not guaranteed because it's just like any real estate that you may own yourself. There may be vacancies. There may be, deadbeat tenants. There may be COVID-19, where, even though you couldn't afford it or you lost your job, you couldn't pay, it affected rents. So it's not a guarantee. However, when you are in institutional type property and you can run your property at 50% vacancy, generally there's going to be a rental payment made to you year in, month out. So the likelihood of it going to zero, unlikely. The likelihood of you getting what's called a capital call, or, hey, Troy, we're doing some repair work, or there was a hurricane that came through and we need you to chip in $50,000. Well, that doesn't happen in the DST, right? They have reserves that have been identified to take care of those things. So that's really the benefit of the DST, is that it's professionally managed and it's professionally run. Not that we're not professionals, it's just that they reserve things and they hold out things in order to address anything that comes up.
Well, thank you very much, Duncan. Jean, would you wrap up the presentation?
I think it's really important to understand every one of these topics. So Duncan went over 4 tonight. You could do a probably multi-hour session on each one individually. So I hope that this was helpful for people to just at least get an idea of it and then maybe have some of your questions answered. But I think but as some of the questions you can see demonstrate, it's really important to talk to somebody to figure out exactly what your needs and your goals are and what your situation is, because it's really going to differ depending on who you are. So you have Duncan's information here.
Yes.
And definitely I would highly recommend that, people talk to people, don't just try to figure it out on your own, because it's a lot to maneuver. So thank you very much. Thank you for everyone who joined us this evening. And again, many thanks to Duncan for speaking for us, and for Elsie for the introduction and for helping me out with the moderating. And I wish everyone a wonderful evening.